Hi guys. Can you hear me? If you hear me, just type one. Go under chats and type one. Okay, guys. All right, I'm going to start the session now. Anyone who's coming, they'll find us already way through. So, okay, if you're with us last week, I guess you still remember a few things that I presented about. And also for today, I know I gave some of you, actually all of you, the lesson, the homework to go, and at least you should have a MetaTrader on your account. So yeah, that was for you guys to go there and try to see if you can figure out how to download MetaTrader and how to open a demo account. So yeah, just a word of advice before I start the session, guys, is that please, uh, what I want to encourage every one of you here is that you have to take this as a business. And why you should take this as a business is because if you are to master this, I guarantee you that for years to come, you will know how to compound your money. So as all of you are aware that every business that is existing out there, the mission is only once. The mission is that all those people, they are on the quest to make sure they know how to compound their money. Whether it's a Choppies business, their mission is the money that they have, they want to increase it. So, and even each one of us, whenever we wake up in the morning, going to work, our mission is to try to increase the little that we have. So that is why I always tell my friends that anything that you do, you have to put your everything. Okay, don't have uh, um, uh, oh, I'll say you don't have a second thing, like somehow you say, let me try Forex, and then it doesn't work, you just run away. No, if you put everything to everything that you do, I guarantee you that you're going to be successful in that thing that you are doing. Okay. So as you know, example, when you are a student, when you are doing that certain course, it was hard, but because you managed to put much effort into it, you at the end you managed to pass, and by passing you get rewarded with that certificate, which now you use to apply for jobs. Okay, the same thing with Forex. When you start, it might seem very hard, and to some of you it might seem Greek, but as you continue on, it will become easier and easier for you to understand. And when you get to that certain level now, when you start to master it, you start making money. Yeah, or the other thing, what always people say is that you have to learn first. After learning, you have to remove L. Then you start to earn. Okay, every business, before you implement it, before you succeed on it, you have to learn first. So this is why this is key and is very important for you. And me as an individual, I'm just offering this for free. I know most of people out there, they will want to teach you all these basics. Yeah, so which there's nothing wrong with it. It's just that some people, they can just offer you something for free, and some can say, no, you pay for these services. So with that start, I'll be starting today's session. Just a review. Last time review, we're still under Forex basics. So yes, and as I guess some of you still remember what we talked about, what is Forex and how it works, and the kind of brokers that we have there, dealing desks, no dealing desks. Yeah, some brokers that act like casinos and the likes. And also we talked about the time frames that are out there. As you know, the Forex market that is operating 24/7, or it's a 24-hour period. Okay, and that is held because of different time zones out there. Okay, and yeah, and the other thing, we learned about few key terms in Forex. As you know, you'll always hear that there's a word Forex, which means a foreign exchange. Okay, and we also learned something about the commonly traded, or the common currency pairs. Okay, which some people, they can even call them measures. All right, and we also learned about what is a base currency and what is a code currency. All right, we also learned a bit about what is a selling price, buying price, what is a bid, and what is an ask. And also we learned about something called a pip and a spread. Okay, and the other thing that we talked about from the last session is the advantages of Forex. We said something like, with Forex, you are guaranteed, if you master the skill, you are guaranteed to make money even in time of crisis. Whether the economy of the country where you are, it crashes, or anything happens, or it totally dies, if you master and you know how to trade Forex and you're profitable, you will not be affected by that. Okay, yeah, because why? You can trade anywhere around the world. It's an international business that when you take it serious, I guarantee you that for until you die, you'll know how to make money and you'll never be broke. Okay, yes. And also the main disadvantage is that though lots of people trade Forex, 99% of retail traders, they lose money. Only just 1% is the ones that is profitable. So another disadvantage is that it's a high risk business, in that you can lose all the money that you put in. Okay, so the difference between Forex and stock is that With Forex, you can put 100,000 and tomorrow you wake up, there's nothing, like there is nothing on your account. Yeah. And with only when you are trading though, okay? But with stock, you can have 100 shares in a certain company, and tomorrow you still wake up, you still have those 100 shares, okay? And yeah, Forex, yes. The other thing is that it's not for everyone. Why is it not for everyone? Is because you know that as human beings, we are made to serve a purpose, right? Some people are called to be pastors. Some people are called to be teachers. Some people are called to work in the farms, okay? Everyone has a purpose, all right? So if your friends, they don't want to trade Forex, don't look at them and look down on them, because maybe to them that is not their purpose, okay? For you, as you have the opportunity to know about this, and if you find it that indeed this can take you somewhere, it's a good time for you to make sure that you master it, right? And then the other thing that you talked about last week is how just a bit of how market can be controlled by news and events around the world. Okay. Yeah. So this was an assignment to open a demo account with one of the following brokers or any broker of your choice. So, and with that, we ask you guys to download the MetaTrader platform on your computer or your phone, because that's what we're going to use a lot, right? And here, these are my recommended brokers. And like I said, these brokers are the best in terms of withdrawing. When you withdraw your money, they make sure that you get your money. Yeah, they are not tricky brokers, and most of them are regulated, okay? And and AvaTrade, I recommended it because it's low, it's not really local. It's there on, they have their offices. I'm not sure if it's Joburg or Cape Town. Yeah, so if you have an issue, you just take a bus, you go to South Africa there, and they will help you out, okay? That advantage of having that. And with that, that was the end of our session for last time. All right, so for today, we're going to start with this terms here. With Forex, guys, we have few terms here. We have leverage, lots, and spread. Okay, give me a minute there. Okay, yeah, yeah, and the term leverage, guys, here the definition, or all this information that I'm presenting to you guys, I had to find time, research it for you, and compile it nicely for you, okay? So it means through the use of leverage, traders are able to invest a smaller amount of money and trade much larger deal sizes. This is useful because the movement in currency rates can be very small, and larger trades represent larger profits, losses, and every pip change in the rate. Leverage allows you to trade with more money than you have in your account. And leverage is shown as a ratio. For example, you can have 1:100, okay? And you can actually have a leverage to maybe 1:1,000 still, okay? Yeah, so note this. This is very important. If you use leverage, it will amplify both your potential profits and losses alike, okay? So which means you can experience high profits, and this, at the same time, you can experience high losses, okay? So, and then the other term that we have is something called a lot. So in Forex, all transactions can be conducted via a standard lot, mini lot, and micro lots, okay? Each lot size account for a different measure of units of the base currency, which in turn present a different pip values, okay? Below is an example of a chart that illustrates the different lot sizes, okay? So like here we have a standard lot size, which most of the time is around 100,000 units, volume like one lot size, that move just one pip. Okay, here actually what I'm trying to show you there is that a standard lot size, when you open a trade with what you call a standard lot size is the likes of 1, 2, 3, 4. Okay, so it means just one pip move, it will reward you with $10. Okay, if it's in your favor, it will reward you with $10. If it is against your favor, it will be minus $10. Okay, same thing with mini lots. 0.01, 1 pip, it will give you $1. Okay, so micro lot, 1 pip will give you 1 cent. Okay, so that's what those lot sizes actually mean. Okay, the smaller contract sizes have a broader appeal actually to beginners. Mostly as a beginner trading forex, we encourage you to use what we call the micro lot sizes. Okay, this is very important for you as somebody who's new to trading, because the micro lots, they help you actually to learn and to understand how the market moves. Okay, and even most of the time when you are new to a certain broker, let's say you moved from one broker to another, the first thing that we have to do there is you have to try maybe stick to micro lots and mini lot for some time, just to understand how that broker pays or how their spreads and code works like. Example, if you trade things like indices, like NASDAQ, you might find that another broker, one volume or one lot size, it will actually pay you 1 pip move, it will pay you $1, while the other one, one volume or one lot size, it will pay you $10. Okay, so what we have to take on here is that before you move or move to any broker of your choice, you have to understand and find out how much they charge for their lots and how their standard sizes works like. Okay, and also you have to know that some brokers, they have a minimum lot sizes that you can open per any currency you will be trading. Okay, like example, we have synthetic indices. What they trade, you can actually open positions with 0.001. Okay, so as other brokers, you can't. Only the minimum you can open will be 0.1 upwards. Okay, so that is why it's always important when you move to a certain broker to understand how they work. Okay, and the other thing that we have there is a spread. Okay, a spread, it means the difference between the bid price and the ask price. Okay, and if we are to look at the following quote here, example, Euro USD equals to 1.250 / 0.3. The spread will be maybe 0.00 or 3 pips. Okay, or sometimes pips, guys, can be called points. Okay, although this movement may seem insignificant, even the smallest point change can result in thousands of dollars being made or lost due to leverage. Okay, again, this is one of the reasons that speculators are so attracted to forex market. Even the tiniest price movement can result in huge profit. Okay, yeah, what actually is being said here is just to make you to be aware that people, they trade forex because of those 0.0% movements that are happening every day. Okay, so and just like you seen there, 3 pips, it can mean 3 pips can give you $30. All right, so, and some 3 pips, it can give them even $10,000. So it will just depends on how many lot sizes you opened. Okay, so just that minor tiniest movement, it can make you lots of money, or it can make you lose lots of money, right? So you don't need to worry about that for now. Why? Because you're going to learn how you can make money and to be a profitable trader in the long term. Okay, and the other thing here is that here I was just showing you an example of pip values for Euro USD and US dollar JPY, depending on the lot size. Okay, so here it just show you that in this Euro USD pair here, okay, we had if you had to open a standard lot, do I have annotations here? Let me annotate for you. All right. All right. Yes, I needed this. Okay, so here, what it actually means is if you had to open this pair here. Okay, need to change my color to red. All right. Okay, if you have Euro USD here and you open using a standard lot size, remember standard lot size, we have both 1 or 2, okay? And with this standard lot size, every pip, just 1 pip, it will be, or it will give you $10, all right? So a mini lot size here, it will give you $1. A micro lot size, 1 pip, it will give you 0.1. And a nano lot, 1 pip will give you that amount. Okay, so the same thing here. Now, if you look at this pair, USD JPY, okay, so standard lot for this pair, it might give you this amount, this amount, this amount for micro lot, and for nano lot this. All right, so this, guys, depends on your broker. Okay, yeah, this depends on your broker. Okay, and then all right, so yeah, your broker might have a different convention for calculating pip values relative to the lot size. Okay, but whatever way they do, they will be able to tell you what the pip value is for currency you are trading at that particular time. So, and if you remember something that you talked about in this previous slide here, we also talked about spread. Okay, so usually when you open a position, your broker will add few things. They will add their commission, and they will also add their fees. Okay, just by opening a position, the broker will charge you fees. Okay, they will charge you fees and commission. Okay, that is how brokers out there make money. Brokers make money by charging you fees and commission for using their platforms. Okay, and some people they might say no, it's unfair, but it is a fair deal. Why? Because that's the only way brokers can make money, especially brokers that doesn't have the dealing desk. Okay, they make money through fees and commissions. All right, and for the brokers which have what you call the dealing desk, which I said, remember, they act like casinos. Okay, what they make money using, if you lose, they make money. Okay, yeah, for you winning using those brokers, they lose money. So those are a few things that you have to look at when you choose a broker of your choice. Okay, so and then here I just said a few things there, that leverage actually, it simply means you borrowed funds. Okay, while the high degree of leverage used in forex trading magnifies returns and risk, a few safety precautions used by professional traders may help mitigate this risk. Okay, so leverage, guys, is a very aggressive investment strategy, and only those with a high risk tolerance should consider using it. Okay, so here is just I was just comparing this just as a way of to let you guys know that indeed you can make money, indeed you can lose money. Okay, whenever you open an account with a certain broker, you will deposit your $100, and because of that $100, you will be able to open a position that is actually worth $10,000, or that is worth $100,000. Okay, that is because of this leverage. Okay, leverage, it helps you to be able to trade. It could be a stock, or it could be a currency pair that is super expensive to buy with the broker's money. Okay, so that is why brokers, they charge you fees and commissions, is because of that. So example, when you open 0.01, you are borrowing the broker's money. So which means by that 0.1, maybe you have $100 in your account, you'll be controlling a market worth maybe $10,000 with your 100 with your $100 you deposited. So leverage is good and also is not good. But in forex, 99% of traders, they use it. Okay, yes, because why people use leverage is because, one, if leverage wasn't there, you will be needed to have around maybe $5,000 or $10,000 to be able to start trading. Okay. Okay. All right. So here, example here, if we have a leverage here, let's say from last time we're giving example using this euro US dollar, like here actually what's being shown there is that somebody opened a position here. This position was a sell position, okay? And this, it dropped from here down to here. And the person managed to close that position here, okay? Because of leverage, this person managed to make $138,400, okay? Because of using leverage, okay? So that is the advantage of using leverage. So you can see from 1.4 to 1.3. That is just a tiny move. You might find maybe it's around 0.3%. Okay. And with that move, that person managed to make that kind of money. All right. So that is why everyone uses leverage on trading Forex. Okay, I'll move to next slide. Yeah, and the other thing here, as a trader, guys, you should look to use proper leverage most of the time, 10 to 1 or less. Okay, so and there's a research that was carried by a few people. It shows that the amount of capital in your trading account can actually affect your profitability. Okay, traders with at least 5,000 of capital tend to utilize more conservative amounts of leverage, right? While people with small money, with less money or less amount, they tend to risk higher. Okay, so this guys is focusing on people who have a set rules that they are trading, or who have a certain strategy that they are trading. If you don't have a strategy, there's a high possibility that even $5,000, it won't be nothing. You will lose that $5,000 in a week or even in a day. Okay, if you have a trading strategy that has its own rules and a program that you are following like a robot, I tell you that with $5,000, you can make lots of money. Okay, yeah, because the more money you have while trading and having a strategy, the more you become conservative. Okay, so that is something that as you'll be starting to get into Forex, you have to consider this is very key and is very important. Okay, don't have this mindset of wanting to be a millionaire in a week or in a year. No, it doesn't work that way in Forex. Okay, the more money you have in your account, the more money you can make. Okay, and also what is very important is this: if you have example 50,000 pula on your account, the rule is that at any given time you are only allowed to risk 1% of your whole account. Okay, that is something that is very critical. So 1% of 50,000 pula, it means that you should only risk 500. If you have 50,000 pula, the amount that you can risk on that on any given trade is 500. Okay, so that is how risking and using leverage is very important there. Okay, so now if you have $100 and then you open 0.01 account, you actually risked your whole account. Yeah, so you can even lose that money within 3 seconds when there's news. So yeah, okay, so it's very important now to have a skill, a strategy, and a trading plan. All right, so now let's move into this. There's something that we call bulls and bears. All right, okay, there's something here that will help you to memorize what is a bull and what is a bear. Okay, so now in Wall Street, or you can say on trading, we have bulls and bears, okay, which are always in a constant struggle. If you haven't heard of these terms already, you are undoubtedly will as you begin to invest or trade Forex. the term bull market and bear market, guys, it describes upward and downside market trends. Okay, yeah, and these are used, guys, to describe either the market as a whole or specific sectors and securities. Okay, this images here is just to help you with something. Why they call it a bullish and bearish action? A bull, you know, whenever a bull fights, what it does, it uses its head, right, to push whatever it does up. I get it. So what a bear does, it strangles its victim down. Okay, so which means bullish action, it means the market is going up. Okay, a bearish action, it means the market is going down. Okay, so on this here we have I have this which shows that this is example of a bullish trend. A bullish trend, it will go up like this. I guess some of you have seen that in your hospital cards when you were young. Whenever your mom was taking you to the hospital, you'll always see a graph going up like this. Okay, so most of you, I know you are on a bullish trend. Okay, so if you are on a bearish trend, usually this for kids is for those kids who are very sick or have issues where you lose weight. It will show like this. Okay, so on forex, a bullish trend, it will show a pattern like this. A bearish trend, it will show a pattern like this, going downwards. Okay, I guess I managed to get that clear for you. And now we have also something called candlesticks. Okay, candlesticks are called Japanese candlesticks. Okay, mostly they are used by trading platforms to map the way the market moves. All right, so a bullish candlestick, it will usually look something like that, like this. Okay, and a bearish, which means is going up. I get it. And then a bearish one, it will always be like this, which means it's going down. Okay, so don't worry about this. We'll talk about this in later sessions. Okay, so yeah, here now when you find a chart or a candle like this, let's focus on this candle here. Right, this candle, we have what you called close price. Close price, it means that is where price closed. Okay, so let's say that candle was moved. It's a 1 minute, 30 minutes, 1 hour, a day candle. Whenever you see this, we call it, it's a close price. That is where this is on the bullish candlestick. Okay, which means price closed here. Okay, and on that particular day, it means price managed to reach this area. The top of this is where price managed to reach the area on that particular time frame. That time frame could be 1 hour, could be 30 minutes, or could be daily. Okay, for simplicity, I'll use the daily time frame. Okay, so when you open a daily chart, when you see candles like this, you'll always see these guys here. These guys are called wicks. WCKS. Okay, these are wicks. So the top of the wick, it means that's the highest price reached on that day. Okay, and then here it means that is where the price closed on that particular day. Okay, so the green part, it shows that price was actually it shows price actually moved from here and it went to there. Okay, so most of the time you might find price that this is where price was bouncing in between. And the open price, it means remember we are talking about the bullish candle. Okay, so it means on that particular day price opened here. This is where the price opened. Okay, and you might find that after price opened on that particular day, during the day, somehow price also went down and it reached this area. Okay, and the bottom wick for price is called the lowest price of the day. Okay, so on the bullish candle, what you should always be looking for is where price closed and where price opened. Okay, because most of the candles, pay attention to this, most of the candles out there, they are named using this, the close price and the open price. You might find that a candle that looks like this, it can be called ERC candle, and a candle that's maybe like this, it called something like, it called a doji, right? And also a candle that's like this with just a little bit of wicks. Mostly these ones are called marubazu. Marubozu or marubozu candles. Okay, so the forex market, guys, it's based on candle names. Every candle, it communicates something, and as a trader, every candle, it tells you what is actually happening and what you should do, right? So this is what is very important. Okay, candlesticks, they communicate to you as a trader. They tell you what you have to do at any given point in time when you open a chart. All right, so the same thing is the opposite here. For this one is called a bearish candle again. So we always find a bearish candle when the market moves down. Okay, so this one, a bullish candle, we find it when the market goes up. All right, so with the bearish, it's opposite this. With the bearish, it means price will open here, okay, and price will close here. So looking here, you can see here on the bullish, price closed here, and then it's closed here, and then it's opened down there. Bearish, price will open here and then fall down and close here. The lowest will be down, the highest up. It's just the opposite of the other. Okay, so I guess with that, what you should take on from this is that we have what you call bullish and bearish candles. or the market can be bullish, and the market also can be bearish. Bullish is going up, bearish is going down, right? So keep that. So now, same thing for color variations on your chart. You might find candlesticks that are like this, and you can also find candlesticks that are like this, black and white, red and blue or so, right? So, and here, example here, a doji, when the open and the closing price are equal. So here, it's something called a doji candle. So a doji candle, usually it happens when the market opens and is going to be closing exactly where it started, which means the opening and the closing of price will be equal. So that creates a doji. So usually a doji, it means indecisive moves, all right? And here we have a long-legged doji. Small candlesticks, they indicate potential trend change. And indecision, it means the market is not sure where to move. It can move up or down, all right? Whenever you find a doji candle, you have to know, always remember that the market is confused somehow. The market is not sure whether to move up or to move down, okay? So yeah, and the other thing that you should note is that a combination of doji candle and other candle, it will communicate different scenarios, okay? Typical example, maybe you'll find a doji among other big candles, that it could mean, no, the market is going up, we are going up, or we are going down, all right? So it's a very important signal for us. Okay, so now for you as a newbie, there are a few things that you have to be aware of. We have things that we call key drivers of currency movements, okay? When you trade Forex, that upside and downs, those movements are moved by certain factors, okay? So example here, the key drivers of currency rates are currencies move primarily based on supply and demand. That is a very important key concept, okay? Market moves based on the laws of demand and supply, okay? That is, on the most fundamental level, a currency rallies or it moves higher because there is a demand for that currency, okay? When people do demand a currency, want more of that currency, because of the law of supply and demand, it will rally or it will move up, okay? Regardless of whether the demand is for hedging, speculative, or conversion purposes, true movements are based on the need for the currency, okay? Example here, you are in Botswana, right? If most of people in Botswana, they start to buy more of Botswana pula, which means the demand of that currency will go up, okay? If most of people like, let's take example like Zim, right? There was a time where in Zim, people, they didn't want a Zimbabwean dollar. What happened is most of people were selling Zimbabwean dollar. So because of that, supply was high and it made the currency value or worth of that currency to fall. Okay, that is the law of demand and supply. Okay, so in excess, currency value decrease when there is excess supply. All right, so supply and demand, for some of you who doesn't know, is what moves the market, and that is the strategy that I slowly trade. I trade not using indicators. I trade not using fundamentals. I trade using technical analysis based on the laws of demand and supply. Okay, if you stick around with me in this course, I will show you more how supply and demand works and how it can actually benefit you as a trader. And remember this, what I'll be showing you in the later stage is the strategy that you can use to complement whatever you have now, okay? Because no matter whatever platform, currency, or pair you are trading, it's always the law of demands that are respected, okay? So supply and demand should be the real determinants of predicting future movements. However, how to predict supply and demand is not as simple as many will think. Two of the primary factors affecting supply and demand of currencies are interest rates, the overall strength of the economy. Okay, the stronger the economy, the more demand it has or people have for its currencies. Okay, there are many factors that contribute to the net supply and demand for the currency. Okay, so the number of economic announcements made each day from around the world can be intimidating. So we will focus just on the most important ones. Okay, how are they divided, guys? Economic announcements, we have something called geopolitical conditions, economic factors, and market psychology. Those are the few, and also we have central bank policy divergence and the like. Those are some of the few things that actually move the markets: geopolitical, economic, and market psychology. Okay, those three are what moves stocks, are what moves currencies. Geopolitical conditions, if there's a stability in Botswana, that on its own, it will make our currency lose value, all right? Economic factors, if our economy is performing poorly, our diamonds are not being bought, right? Definitely that will affect our currency still. Market psychology, this is the perception of people about a certain country and its currency. Typical example, there's a bigger psychology out there where everyone thinks US dollar is the safest currency anyone can hedge against lots of factors, okay? Most of people who are super rich in Botswana, you might find that most of their money is in US dollar. Why? Because that is a market psychology, okay? Yeah. So here, these are I got this from Caitlin. Here are one of the few top indicators that move the markets, okay? We have something called NFP, or non-farm payroll, okay? This one, it only talks about the US government. Will United States employment continue to grow or to fall? If the prediction, or if it's yes, which means a US dollar will rise. If the analysis of investors or people who do analysis, they will say no, which means that currency will fall, right? The same thing with Botswana. If the current policies that are being produced are being made, will they help with employment? If it's yes, Botswana currency becomes strong. If it's no, it will become weak, all right? And we have also something called interest rates, FOMC rate decisions, inflation, consumer price index, trade balance, deficit or surplus, retail sales, manufacturing, mostly referenced as PMI, GDP growth, and stock market conditions. These are what moves the market, okay? And though this moves the market, they follow laws of demand and supply. That is key. Okay, so with that in mind, we have, for people who trade news, most of them, they focus on these indicators. They listen to the news, okay? If the news are good, they know which side of the trade they should be in. If they are bad, they know which side of the trade they should be in still, right? So with that in mind, guys, that's the end of today's session.